Hello and welcome everyone. I am your host Ajay Aditya C, and this webinar is powered by Zoho Books, our smart online accounting software. This is the third in the series of webinars on GST, and in today's session, we are going to talk about the impact of GST on different industries. For those of you who are not familiar with the GST, it is an upcoming tax system in India where all the current indirect taxes will be combined into a single tax, and this combined tax is going to be levied upon every goods and services that you purchase within India. And this tax system is expected to come into effect from July 1, 2017. For those of you who wish to know the basics of GST, I have shared the link to our previous GST webinars. So with that, we go to the agenda of today. So we will begin the session by taking a brief look at the four-tier tax system that the GST represents, followed by its impact on agriculture, manufacturing, FMCGs, e-commerce, and services. So these five industries actually play a pivotal role within the Indian economy. And so we thought, hey, why not capture the impact of GST on these five industries? And so here we are. So under each section, this is what we'll be doing. So we'll take you through things that you can expect for each and every industry. And then we'll also throw in some tips as to how you can prepare yourself for the upcoming changes. And that's how this session is going to go. So first up, we are going to start by taking a look at the GST's four-tier tax model. So in one of our previous webinars, actually we have covered the structure of the GST in detail. So in this session, I'm just going to go over it briefly. So the GST Council has proposed a four-tier tax model that includes four different rates. So you start with a zero rate, wherein you actually levy this zero rate on items, essential items such as food grains, cereals, and things that are about 50% items present inside the CPI basket. And then this is followed by a base rate of 5% on goods like edible oil, spices, tea, and coffee. Then you have a standard rate, and if you take a look at the standard rate, you have two sections. You have a 12% bracket and an 18% bracket within the standard rate. And so this 12% would be levied upon goods like computers, processed food, cycles, and then the 18% is going to be associated with most services, as well as some toiletries like soap, shaving razors, etc. And then you have the higher rate of 28%, which is going to be levied upon luxury goods, demerit goods, and such. And speaking about the sin goods, so you have an additional cess which is going to be associated to those demerit goods for the first 5 years. And so that's really going to take up the tax being associated with those goods. So the bottom line that you can observe from this system, by concept, GST is set to unify all the 17 and odd indirect taxes. And now we are seeing some four different rates prevalent within the same system. And so with this, one can observe that different types of products and services will still continue to have different tax rates, and consequently different industries will be impacted in different ways. But one thing that acts as the key takeaway here is that for a single item throughout India, the tax rate is going to be uniform throughout the country. So that unlike before, because if you take a look at the existing VAT system, wherein you have different VAT rates for the same item across different states, but under the GST, for one item that you sell, the rates are going to be uniform. So that's the takeaway here. So in order to understand the implications of this four-tier tax system across different industries, let's begin with agriculture. So, agriculture has always been the root of our Indian economy, and during our independence, this particular industry actually played a major role in the sector as it contributed a lot to the GDP back then. But then over the years, things have changed, and then slowly manufacturing took the lead, and finally today we have services doing the most contribution to our GDP and such. But still, this is one of the essential sectors prevalent in India. And so, with that in mind, the government has zero rated most agricultural goods such as food grains, cereals, and any of the other 50% of the items present in the consumer price index basket. So, this is something to take note. They have made sure that these items are not associated with taxes and they remain tax free so that it is accessible to everyone. That said, certain parts of agriculture will now come under the GST. If you take a look at processed grains, cash crops, and milk based products, so these kinds of items are going to be taxed under the lower bracket of 5%. So we have seen that different parts of agriculture are associated with the GST in different ways. The question arises, so are farmers required to register themselves under the GST? And if it's yes or if it's no, who else is also likely to be brought under the GST? So there are a couple of questions that we have to ask ourselves. And the answer is traditional farmers need not register under the GST. So, people growing the essential crops, they still don't come under the purview of GST. That said, please note this is really important. Farmers and agriculturalists who are involved in contractual farming will now come under the purview of GST. And by contractual farming, what I imply here is that if suppose a particular farmer has a contract with a restaurant chain or a fast food chain to specifically grow certain products for them, and then in such cases those kinds of activities are going to come under the purview of the GST. This means that everything that you eat from a fast food chain is also going to see the impacts of GST as it is now being associated with their raw materials. We'll take a detailed look at that in the following slides. The next thing that we have to take into note would be the middlemen and the retailers who trade in agricultural commodities. So these could be some sort of wholesalers or people who just buy goods from farmers and then sell it to customers. Even though the farmers are not under the purview of GST, still, if these people are buying from farmers directly and then selling them, then they have to pay a GST associated with those goods. So, these kinds of people are now going to come under the purview of the GST. And this shift will actually affect many multinational fast food chains as they are now required to pay GST on all the purchases that they make from these farmers. And then this can subsequently affect your bill when you order that burger or that pizza after July 1 this year. So, what can you expect from the GST coming into the agricultural sector? Well, for starters, the price of food grains and other essential commodities are most likely to remain the same because most of the essential goods are still zero rated, so that's a good thing. While the processed agricultural products like rice bags and milk products, so those are coming into the base rate, so most likely the prices will stay the same. Then the second takeaway here is that eating out is going to get a lot more expensive for various reasons. The first reason being taxation on contractual farming. So if you take any popular restaurant chain within your vicinity, especially the bigger ones, the multinational ones, they actually have contracts with farmers directly, so that these farmers produce goods like potatoes and other crops for them, and then they ship it to them. So such goods and such transactions are now going to come under the purview of GST, and so that's going to increase your prices in one way. The second reason for eating out to be more expensive is going to be the part on services. Right now, within the current indirect tax system, you would most likely see a service tax of 15% on 40% of your bill sitting on any order that you make from restaurants. But then under the GST, this rate is going to increase from 15% to 18% on services. So that 3% increase is also going to affect your bill. And then finally, even if you have wholesalers and middlemen buying goods directly from the farmers, in such cases, even they have to pay a GST to the government. And so putting all of these things together, eating out is going to get a lot more expensive. So it's time you started cooking. And next up, the final takeaway here is that contractual farmers, agriculturalists, wholesalers, and retailers who sell agricultural products will now be under the purview of GST. So these folks have to get themselves registered under the GST. And yes, so how to prepare yourself for the upcoming changes? So if you are a farmer or if you are in the agricultural industry, the very first, or any industry for that matter, the very first thing that you have to do is to be aware of everything associated with the GST. I know this can sound complex and boring, but then if you take a look at taxes, they are like the lifeblood of our country. And so you can actually learn about the GST either online or with the help of a consultant. You can just get to know more about it. And the good news is the government has already produced a lot of resources on the GST, and more are coming out. And many other people have also published articles and resources which are available to you online. So you can really get to know about the GST, and a lot of things that are present within the current system which are a bit ambiguous have been clarified within the GST system. So make yourself aware of the GST. Next, find out if your business is liable to pay GST. So if you talk about eligibility conditions, one of the main conditions would be your aggregate turnover. So for the major part of India, if your aggregate turnover is greater than or equal to 20 lakhs a year, then in that case you are liable to pay GST on your transactions and collect them as well. So that is something that you really have to note. And for northeastern part of India, this threshold is actually 10 lakhs. So if you're eligible for GST, then please get yourselves registered as soon as you can, so that you can smoothly transition from the existing system to the GST. And then while you are making this shift, I would also recommend you to migrate from manual bookkeeping and spreadsheets. Why? Because you have to now start filing returns online. And then if you switch to an online accounting software, then it's going to be pretty easy, as all your taxes can be filed very easily. Now we come to the manufacturing aspects of Indian economy, and so we are going to see how the GST affects our manufacturing. So as one of the biggest contributors to our economy right after services, the manufacturing industries are actually subjected to an array of tax, and these taxes are levied at each and every level. So if you take a look at the manufacturing industries, one popular indirect tax that immediately comes to our mind would be the excise duty, which is actually levied on production of items. And so if you take the rough cost of production for any manufacturer. This is just a general chart right here. So it could be any industry. So when they source raw materials, then they have to pay the cost of those materials along with any shipping, delivery, and handling charges or any duties associated with it. And if they source these items from a vendor located in the same state, then there is going to be a VAT associated with these items. But in an off chance, if they source these items from a vendor located in a different state, then you are going to expect a central sales tax, an octroi, and some local body taxes that you might have to pay at every state border checkposts. And then let's say they hire some services, employees and such, and then they produce these goods. So when they do that, you're going to have a excise duty sitting upon your items. And then you have employee wages, any services they hired. So all those services are going to come up with a service charge, and then a service tax is going to be associated with those services, and then there are miscellaneous costs. So putting it all together, you see a lot of tax right here within this general chart. So that is the exact reason why I brought this up. So not only this is tedious, but one can see that these taxes are being passed on to the end consumer. So if you take a look at the current tax system, even though the VAT system is a value added system, but then there are certain taxes like the CST which cannot be associated with anything close to an input tax credit. So you won't be able to claim any credits on CST and other local body taxes during an interstate trade. So such things are going to be passed on to the end consumer because they'll be added to the value of the product, and then ultimately a tax is going to be associated with an already taxed amount. And so this tax cascading will ultimately affect the end consumer. And if you take a look at the current state within India, it is said that any item that you purchase from the Indian market is said to have about 30 to 35% in taxes. So that's a lot of money going into tax. So if you buy anything, maybe an LED TV of maybe 1 lakh rupees, then imagine that you are actually paying about 30,000 as tax. So that's a lot of money, right? Good news here is that the implementation of GST is expected to change things around by lowering the cost of production. Well, this sounds good, but then how does the GST do that? Well, here is how. First thing that we need to understand here is that GST allows an unrestricted flow of input tax credits within the entire system. And so manufacturers will be given credit for tax paid on capital goods. So any raw materials or anything they purchase, and then any form of transactions they do, they are actually going to get input tax credit on all taxes that they pay as soon as they take the items to the next step. And so this is actually going to increase the revenue that they are getting, and so this benefit can be passed on to the end consumer as well. And further to this, GST is going to be subsuming all those 17 and odd indirect taxes that were governed by different tax authorities. So now manufacturers have to deal with only one tax authority which is governing the GST. And the good news is the paperwork is going to be uniform throughout the country, and so it's actually going to simplify a lot of stuff and then clear up the way for manufacturers, and so it's going to be better in a multitude of ways. And finally, just like the VAT system, but at a more granular level, the GST operates on the concept of value addition. So taxes are going to be levied only upon any value added at that stage of the supply chain. So that is pretty much going to lower a lot of additional taxes which are being passed on to the end consumer. And so through these advantages or through these measures, the GST is going to lower the production cost. Well, all that is great, but then what about the time and effort spent on tax compliance? Will it be the same? Well, one problem that is evidently faced by all manufacturers is that when you source your goods from a vendor located in a different state, it's going to take some quality time for those goods to reach you. So it's going to take pretty much some extra time. Why? Because the truck has to pretty much stop at every state border check post in between, and then they'd be checking the paperwork, and then if there are any taxes associated with it, like CST for instance, so they are actually required to pay them at these state border check posts. And a study has actually indicated that 40 to 60% of a truck's transit time is actually spent upon these state border checkposts. So you can pretty much imagine the ordeal faced by all these manufacturers, because they have to wait for the goods, raw materials to arrive. But still, anyway, manufacturers have found a way around it by scheduling their manufacturing process accordingly so that they receive the goods in time. But then sourcing itself is a problem with the current system. And so, good news is nope. You can buy and sell your goods faster once the GST arrives. Why? Because instead of the CST, octroi, and the local body taxes, which are individually specific to each and every state, those are going to be subsumed under a single GST called the IGST, or the integrated GST. So this is going to be uniform throughout the country for a given product, and then this will be collected by the central government on the interstate trade, and then it will be split between the destination state and the central government. So that's another story. But then this integrated IGST is going to actually simplify and uniformize your rules, and then this is also going to mean that you don't need a specialized tax crew to set up the paperwork. And the removal of these taxes also mean that less time is spent on state border checkposts. In fact, it would almost remove the need for a state border checkposts, because anyway, for any sale that you make, you actually have to pay taxes. And as things are documented automatically within the current system, so no longer the intervention by these authorities is needed. And also another thing to note here is that trucks will ply using designated trade routes. So under the GST, so there are going to be certain designated trade routes for interstate traders, wherein they can actually supply goods or receive goods through these routes. And by designating these routes, the government has actually made it something like a green gate pass for trucks, because you would not be checked or intervened during the transit if you apply using those routes. So yes. So are there any downsides? So pretty much all the above mentioned points actually are on the plus side of the current system. But then every coin has two sides. And so on the downside, small scale industries will no longer enjoy excise duty exemptions after July 1, 2017. Well, this is seriously a bit hard, because the exemption threshold is no longer 150 lakhs. So in the current system, if you take a look, if your turnover is like 150 lakhs, and during the previous year, if your turnover did not exceed 400 lakhs, then you were no longer required to pay excise duty during that financial year. But then right now, the threshold for GST exemption has been brought to 20 lakhs in major part of India, and 10 lakhs if you are in Northeast India. So that means most of the small scale industries are now going to come under the purview of GST. And so this particular exemption is pretty much non-existent right now. So that is going to be the downside. So the summary, so what you can expect out of this particular industry. So first up is going to be lower production costs, and then you have lesser litigation and simplification of rules, which would actually promote the famous Make in India drive. And then you have faster sourcing of raw materials and quicker delivery of finished products due to the elimination of those multitude of interstate taxes and also those checkposts. Even though the checkposts will still continue to exist, but then the time spent on these checkposts will be diminished. And then the absence of exemptions on small scale industries is actually going to increase the prices of products from these industries. So these are the things that you can expect out of the GST. And so to prepare yourself, the same things that we saw within the agricultural sector is also going to apply to you. So get yourself registered as soon as possible and then start transitioning from the existing system into the new system. And yeah, accordingly also tailor your invoices to match with the GST structure. So those are some of the changes that you have to do in order to prepare yourselves for the upcoming GST. With that, we are now looking at the next industry in the picture, that is the fast moving consumer goods or FMCGs. So if you take a look at this industry, it includes food, beverages, household and personal care items. And for this particular industry, the items that are prevalent here are currently liable to a total tax of greater than or equal to 26%. This is because of putting together the excise duty, VAT, and so on, except on agricultural products. So if you put them all together, you are having a very high tax rate sitting right for these goods. But then after the GST, the taxes associated with these goods are going to lie within the standard rate. So it's going to be between 12 to 18%. And so we will see a drop in the prices of most FMCGs. While with respect to food products, as we saw in the earlier sections, processed food is taxed slightly higher. And so it's going to have an inverse effect right over there. So that was with respect to the prices of these products. But then if you take a look at the FMCG as a whole, the biggest impact of GST is going to be on the distribution aspects of this industry. So today, distribution costs for FMCGs account for up to 7% of their business turnover. And moreover, if you take a look at the 17 and odd indirect taxes, which are governed by multiple tax authorities and which are varying through different states, then these companies actually have to find a way using their supply chain around these taxes. In order to avoid the barrage of these interstate taxes, they have actually set up a warehouse or a distribution center in every state they operate. So why did they do that? Well, for instance, if you have your customers located in maybe Rajasthan and then you are a FMCG company in Maharashtra, so in such cases, if you are sending goods from your place to say Rajasthan, then if you sell them directly as an interstate trade, then a non-refundable CST, octroi, and some local body taxes are going to be sitting on top of the bill of the consumer. And if and that consumer, if he or she is also a trader located in that local area, say Rajasthan, then when they sell the goods, they won't be able to take input tax credit on such a transaction. So it's actually a downside for the both of you. So neither will you be able to claim ITC nor they. And besides that, the additional checks and the paperwork required for such a transaction is also complex and unique to different state. So all these complexities have actually forced the vendors to set up multiple distribution centers. So right now, a vendor in Maharashtra would actually have a distribution center in Rajasthan, so that they would transfer the stock ordered by the retailer or the wholesaler within Rajasthan from their Maharashtrian warehouse to their Rajasthan distribution center, and from there they'd be sending the goods to the local consumer. So this way they convert an interstate trade into an intrastate trade, and there you just have a VAT associated with this transaction, and VAT is actually refundable. Then after the GST, local and interstate supply will be tax neutral. So you would be seeing uniform tax rates throughout the country, and as GST allows for an unrestricted flow of input tax credits, any excess tax that you pay is going to be refunded to you. So that's how the system is going to work. And with this system, India is going to be treated as a single common market. And one thing that pretty much you have to note is that companies are no longer required to have multiple warehouses in every state that they operate. The reason being here is that there is one downside to the GST, which means that the GST does not distinguish between supply to a third party and the supply to self. So if you are transferring stock or if you are making a sale, it does not matter. Whatever you do, if your items are being moved from one state to another, you are liable to pay GST. And this GST, if it's not a sale, if it's just a transfer of stock, then this GST would be levied upon the value of goods being transferred. And even if you try to wean it out by zeroing on the value or by nil valuing the item, even then the GST would be levied upon the market value of those items. So beware and try to have your main warehouse situated in a centrally located place like Madhya Pradesh, for instance, wherein you can just outfit all the surrounding markets easily. So that is going to save you a hell lot of GST that you might face if you are going to continue using the same structure of supply chain. So this shift is basically directed at these companies so that they can shift from a tax saving logistics model to a market centric logistics model. So kindly make those changes. So the biggest change or the biggest thing that this particular industry has to prepare for itself is to remove the additional layer of supply chain that you have right now. Instead, you can have your main warehouse or the main distribution center located in a centrally located place so that you can easily outfit all the surrounding markets. And if that does not work, then probably you can go in for a consignment model or something like a commission model, which could actually help. So with that, we come to the next sector, the e-commerce sector. So this is actually an up and coming new sector that is expected to become an $18 billion market by 2018. And so the government has specifically focused upon this sector and has tried to address many ambiguities that are prevalent within the current tax system for this sector by bringing in the model GST law. And the good thing to note here is that the model GST law has dedicated a chapter on how to handle taxes for e-commerce specifically. So you can notice the amount of importance given by the government for this sector. And so before we look at the impact of the GST on the e-commerce, there are three different models of companies present within this industry. So you have the marketplace model, you have the inventory model, and you have the aggregator model prevalent within e-commerce industries. So the marketplace model actually involves companies that showcase products from different vendors. So it could be an e-commerce platform like Flipkart, Amazon, Snapdeal, etc. So they are actually classified as e-commerce operators by the government, and they operate using the marketplace model. And every e-commerce operator has to actually file the GSTR 8 tax return. So there is a dedicated tax return for such e-commerce companies that operate using the marketplace model. Another thing to note is that if you are operating through the inventory model or through any of these models, you could just be a retailer who is selling goods normally, as well as certain products through an online channel. In such cases, it does not matter whether your aggregate turnover is lesser or greater than 20 lakhs, irrespective of what your aggregate turnover is. If you sell products through an e-commerce portal, then you are liable to pay tax under the GST law. So e-commerce anyhow will attract GST. And so that is something very important for you to note. So and the next up, we have businesses operating under the inventory model. By inventory model, I refer to all those companies that have their own website, and then they sell products through their own website. So they don't showcase products of different vendors, but they are the vendor who is selling products through their own platform. So these folks will be taxed under the standard slab of GST. And yes, anything under the e-commerce is actually liable to pay GST. And so all of these different models that are present, they have to get themselves registered. Then finally, we have the aggregator model. A very good example of this model would be companies like Ola, Uber, etc. So these companies will collect and pay tax to the government on behalf of service providers listed under them. So if you take a look at Uber, for instance, so when you take an Uber ride somewhere, you would find some taxes associated with your ride. So on behalf of the driver, Uber will collect this tax and it will pay this to the government. So that's how this particular sector is going to operate. One impact would be during the current system, actually there are a lot of things that are unclear, and so the tax system did not actually venture much into the e-commerce industries. But now that the GST is going to penetrate into this particular sector, you can actually expect the prices rising for the e-commerce industries. And another very important thing to note is that the freebie model or the buy one get one free model is not going to work, because your customers have to actually pay GST on the freebie item as well. So you have to actually think out of the box and bring in new kinds of promotions so that you don't invoke the ire of your customers. And with that, we finally come to the services industry. So this sector is the biggest contributor to our GDP since the 90s, and this is rapidly growing with scores of industries operating under its net. And the growth of the IT and the ITES companies during the past 2 decades has actually given a massive boost to this particular industry, especially after the globalization. And this particular sector has been generating a lot of revenue, but then the current indirect tax system has not laid out a proper way to address the services sector. So there are certain loopholes prevalent, and certain things are not clear within the current indirect tax system. And even though the central government, so if you take a look at the services in sector, the central government started out with a service tax on 3 services, and then slowly it grew to 6, and then there were like 15 services during after a couple of years, and then finally today we have a negative list. But every kind of service that you actually offer to your customer outside of the negative list is taxable, and as per the current indirect tax system. So as you can see, our service tax system has actually evolved over the years, but still it is inadequate to fulfill this industry as a whole. And so the GST has paid special attention, and it is trying to solve the challenges that were presented by the current indirect tax system, so that all sorts of litigation that arose during the system that is prevalent today would be solved using the GST. Let's start with technological services. So the pros will be that GST will eliminate multiple tax levies. Right now we have so many different types of indirect taxes which are actually non-uniform throughout the country, and then there are various conditions that have to be met. So GST's main objective, as always, is to be simplifying everything that is available within the structure of a tax system. And so it will eliminate multiple tax levies, and then it will make things more transparent. And as information is available to you online, so anybody can actually refer to it and then accordingly stay compliant with the GST. Another good news is that in between there were talks wherein people were expecting the benefits enjoyed by companies in special economic zones to be non-existent after the GST. But thank goodness, the benefits that you are now reaping within special economic zones will continue even after the GST. So that is something to note here. And so when you come to the cons or the other side of the coin, so IT companies servicing a single contract will now have to individually generate invoices from all business locations. So for instance, if you have an ongoing project, so you would have a office which actually onboarded that particular client, and then there would be a project office set up to assist the client easily, and you would also have other locations assisting in that particular project. So a single project can have its work split up between multiple branches of an IT company. So under the current system, you just need to give them a single invoice from one of these branches or the main office with which it has a contract. But then under the GST, every branch that provides a service to the contracting party, they have to separately give out invoices for the services they provide. So this is going to actually complicate things after the GST. Next up, the other important thing to note is that on services, the GST rate is actually going to increase, meaning right now you have a slab of 15% service tax on services provided throughout India. But then under the GST, it's going to be 18%. And so this 3% increase could actually affect the prices of all services that you might render from these companies. Next, we have telecommunication. Well, this is a very important service industry prevalent within any country in the world of today. So, on the bright side, well, GST will bring down and standardize prices of handsets across all states. This is because the VAT rates, which were different within the current tax system, they are going to be subsumed under the GST. And so, for a particular item, the tax rate is actually going to be uniform throughout the country. So it does not matter where you buy that handset. So the prices are going to be uniform, at least from a tax perspective. And then the lower production costs, which we saw during the manufacturing sector, is actually going to contribute to lesser prices. And then as FMCG companies, not just FMCG, any company that has a vast supply chain network, as they are going to cut down on the unwanted levels of supply chain, the distribution costs are going to get lower. And so you can expect the prices of your handsets to go down. The cons, well, on the contrary, the main downside that we are going to be faced with after July 1 is going to be the increased tariff rates on all calls and internet data, because the GST rate associated with services is 18% as opposed to the current service tax rate of 15%. So that's going to take all prices up by a notch. So yeah. Next up, we have the media and entertainment sector coming into the picture, and things are actually looking bright for direct to home dish TV providers, film producers, and multiplex owners who are currently liable to a non uniform entertainment tax on top of regular service tax. So, if you take a look at the situation right now, they also have to pay an entertainment tax, which is actually non-refundable and non-uniform. So this entertainment tax actually is complicating the price structure of these people. But then the GST regime is going to bring down the tax levied on their services by 2 to 4%. So when you put together the service tax plus that entertainment tax, it's actually higher than the GST of 18%, which would be levied on these services. Additionally, as GST would offer a very uniform and unrestricted flow of ITC, so this is actually going to increase the revenue gained by these people. And so they can actually choose to pass down this benefit to the end consumer, to us. And this move is also going to make the movie ticket prices uniform throughout the country. So currently in this case, if you take a look at the different states and the different movie rates that we have, so if I have to say watch a movie in Bangalore, so that's going to cost me more than 300 bucks for a single ticket. But then if I watch the same movie in Chennai, so I just need to pay 120 bucks. So you can see the difference. And one of the biggest reasons in this price difference is the taxes. So once GST comes into place, the uniform taxation would mean that the movie ticket prices are going to get a lot lesser. And the bottom line here is that you will be able to watch more movies per month in theaters. So with that, we are going to the insurance industry. So life, health, and motor coverage will be more expensive starting from July 2017, as taxes will go up by 3%. And another thing to note is that you can no longer claim input tax credit on life and health insurance. So these two changes are actually a bit on the downside for this particular industry. And so your protection cover is actually going to get a lot more expensive after the GST. And when we talk about real estate services, especially the sector wherein we talk about lease and renting out stuff, so according to recent developments, if you are renting out your property, it could be a commercial establishment or it could even be a residential establishment. But then if you are renting them out for commercial purposes, so if you are renting them out for a company or any form of business, so in such cases your rent will also attract a GST. So this is something to take note. So finally, we have air travel. The reason why I picked air travel over the others is because this sector actually represents all other travel industries. So air travel in India will become far more expensive, as the current service tax of 6 to 9% will be replaced by a GST of 12%. So this is actually going to hike up your prices by 3%. And so you can actually expect your air travel to get a lot more expensive. So with that, we come to the general summary. We saw how GST impacted 5 different industries as a whole. And with that, we conclude that GST will have a non-uniform impact on different industries. And even though it will have a non-uniform impact on different industries, one key takeaway is that the GST rates for a particular item or service is going to be uniform throughout the country. So it's actually going to eliminate tax cascading because it acts upon the principle of value addition. So whatever GST is going to be associated or levied upon the item that you sell is only going to be upon the value that you as a seller has added to that particular item. So it will eliminate tax cascading. It will improve transparency and revenue generation. Well, speaking of transparency, when you register for GST, if you buy from registered GST vendors, then it is easier for you to claim input tax credit whenever you make a sale. But then if you are buying from vendors who are not registered for GST, then you may be missing out on this particular option. And also the same applies to blacklisted vendors. Then this system will also promote free movement of goods and services across the country. So trucks carrying goods from one state to another are going to move on a lot faster because of lesser interruptions under the GST system. And so all of these things actually look bright for us. On the flip side, services offered by the service sector is actually going to be a lot costlier. And same applies to certain aspects of farming as well as small scale industries. So these are the things that we have to take into measure. And one other thing is that all the sectors on a whole have to upgrade their technological faculty in order to keep up with the upcoming changes. And also, by upgrading your technological faculties, you actually can now directly link up with the government in a sense, meaning you can submit your tax returns online, and so you can actually remove a layer of unwanted steps across all your transactions. With that, we come to the end of today's session. So if you have any questions, information, or feedback that you would like to share with us, please feel free to write to us. You can reach us by dropping a mail to support@zohobooks.com, and we'll be happy to talk with you. So, signing off once again, I'm your host, Ajay Aditya C., and I thank you all for listening. Take care. Bye bye.